Okay, in this lesson, we're going to cover everything that you need to know about liquidity lines. These are the red and green lines that are left behind on the ATS chart mapping software. This is the third and final main component of the ATS chart map. So what we're going to cover is how are they formed, how are liquidity lines formed, what do liquidity lines represent, and why are they important for understanding markets. So how are liquidity lines formed? Liquidity lines are left behind every time there's a new expansion line formed. So every time we go into the expansion phase, you get that white line. It's going to be accompanied by a liquidity line as well. They come as a pair. If it's an upward expansion, a buy liquidity line will be left behind. If it's a downward expansion, a sell liquidity line will be left behind. So what do liquidity lines represent? Liquidity lines represent the sensitive price levels where traders will be pressured to close their trades. So these are the ultimate points where if traders have entered a buy or sell position in that recent structure, it breaks out and price comes back to test that liquidity line, those traders are going to be out of the money and they're going to feel pressure to close those positions, whether they be buy or sell positions. Red lines are where traders will close out their previous sell positions, so they previously sold the market, which will cause them to buy, so it'll cause a flood of buying demand to enter the market at that red liquidity line. Green lines are where traders will close out their previous buy positions, causing a flood of selling demand to enter the market. We're always looking to do the opposite of those traders, so when they're getting forced out of the position, we should be looking at, is this an opportunity to do the opposite? So if they're being forced to sell their position, should we be buying? If they're being forced to buy or close out their sell position, should we be selling? That's what those lines represent. Okay, let's take a look at a quick example of what I'm talking about here. So we have some market activity here. We have a contraction phase right here, of which it broke out long. So the traders are naturally going to want to buy as we break out of that contraction period because it's confirming that long price movement. With that, it's going to come a liquidity line. See, it says T1 breaking point. So that's going to be, if they bought right there in that breakout, that's going to be their breaking point. Now there's another contraction phase here and another breakout to the long side. So we're going to say trader 2 now buys here. So we got traders getting heavy on the long side because they're seeing the price crawl up. Now, market comes down, test those breaking points. Those traders now are out of the money. They feel uncomfortable. Trader 1 and trader 2 sells for a loss because it's below where they got in. Market makers always doing the opposite. We're trying to do the opposite of what the masses do. So this becomes buying opportunities for us. Remember, they're selling those buying positions. We want to do the same as the market makers. We want to do the same as the smart money. Since the heavier, the smarter money is coming in to buy the market, it's going to cause the market to go up. Trader 1, trader 2 jumps back into the market because now they say, okay, it's really going long now. This is it. This is finally the trend. They jump in. Market maker sells for profit back to the same people that took a loss earlier, and the cycle goes round and round and round. So those liquidity lines are going to help you to understand the market framework and this activity as it plays out. So why are liquidity lines important for us? Liquidity lines play an important role in understanding the market maker's risk profile. Okay, let's take a look at another example here. Going back to that same section of market we looked at before. Remember, we had the two contraction phases, which, remember, those were the market maker's balancing point from the previous lesson. If those are a balance point where you have your expansion and you have your box, and that's defined, then those liquidity line levels become a future unbalancing point because we know that a buying or selling demand is going to come into the market as traders are forced to get out of their positions, that their positions, their beliefs are being tested. So those become market maker unbalance points. Now, how the market makers treat those unbalanced points gives us a lot of insight into what's going to happen in the market since the market makers control the floodgates of liquidity. So the fact that the market makers, we had this strong reaction to the upside shows us that the market makers book is naturally filling with buy positions. As it goes up, traders are going to want to chase the market like we saw before in the before illustration. This means the market maker's book is naturally going to fill with sell positions and rebalances. In this ideal scenario, which the market makers love, they're not only able to collect the spread inside the boxes, but they're actually able to collect some profits out of the actual market move. So this is an ideal situation for a market maker. Market entries and exits become based on available liquidity for market movers and not our own models. When we're using liquidity lines for our analysis and seeing how price interacts with those levels, those are sensitive levels for big money movers. So it keeps us focused on the people that are actually going to move the market so we can tag along and figure out what they're doing. Let's take a look at an example. Let's take a look at this section of market here. You notice we have all these green liquidity lines down here at the bottom of this turn. This is where market movers, big money, smart money, they're able to buy the market with plenty of available selling demand. Remember, the green lines represent where people who have previously bought are now getting forced out, or they're getting pressured to close those buying positions, causing selling demand. The other side of that sell is a buy for the smart money, right? So all through this turn, they're able to pick up that through that selling demand, they're able to fill a giant buying position. As the market moves up, now market movers are able to scale out of their positions with plenty of buying demand. Remember, they're always doing the opposite. That's how the smart money trades. If everyone traded the same, there'd be no edge. So understanding these liquidity lines and using them in the map can give you a sense of where the markets are, when the markets are turning, and also give you those projected price targets once you actually catch the trend. Where is this market potentially going to push to, and where should I be scaling out of the trade myself? So you align yourself with that smart money. So in conclusion, with why liquidity lines are important, liquidity lines give ATS traders, they give you advance notice of liquidity that will create opportunities and shape future market outcomes, thus becoming a map of the future. So when you put liquidity lines together with expansion lines and boxes, you get that entire stable framework that gives you the deep inside view of the market and allows you to predict with excellent accuracy what the possibilities are of the future. You know that if it goes through a sensitive level and it acts a certain way, it's going to mean this. If it goes through another sensitive price level and it reacts this way, you know it means that. So it allows you to act in real time the same way the smart money does. So that does it for the basic explanation of the three main components of ATS software. Remember, you got your boxes, you have expansion lines, you have liquidity lines. Each has its own meaning and its own purpose. Use them together as a map to hone in your skill on understanding markets. And remember that understanding markets and learning to trade markets on this deep level does not happen overnight. So give yourself sufficient time to get familiar with this software, reference these videos multiple times if necessary, and build your knowledge over time. It's a long distance race. Don't try to get it all in a day. Take your time, take it in, and build experience.